Well, good morning, everybody. We're just getting some snow here in Vermont. I'm not sure if everyone is getting it in their location. Being it's, at middle of December almost, it's nice to see some snow coming down, and I'm sure all the skiers or outdoor activity people are getting kind of excited. I know I am. And so thank you for joining our call today. Mike Miller is with Crucial Consulting. Name changed, same great people, just a different name. And Mike, if you need to add anything, I'm sure you could mention that today. Um, we're going to be talking about our performance in the investment area and the strategy and do an update. This will be our last call for this year, and then we'll put out our agenda and our calendar for next year in the near future. So with that, I'm going to turn it over to Mike Miller. And Mike, thanks so much for joining us today.
Thanks, Deb, and good morning, everyone. It's I actually can't see you because I'm sharing my screen, so I'm looking forward to turning off the screen later and maybe seeing many more of you, or a lot of you, hopefully. So it's a real honor to be here. And I do want to address quickly what Deb just mentioned a minute ago, which we have changed our name. And we did that for really a couple of reasons. One is none of us picked the name Colonial Consulting. It was chosen when the firm was founded in 1980. And I'm the, I don't like to say the old person, I'm the mature person at the firm. So I've been there for 34 years and I still had nothing to do with picking the name. So we wanted a name that we thought reflect us a little bit more. And the idea of Crucial, which is purposely misspelled, by the way, which some people really love and some people don't, which is basically around competitive rowing and the idea that strong teams make for a better outcome, and the dependence of each other on one another is really important in rowing. If you've ever been a competitive rower, you know what I'm talking about. So that's the idea behind it. But as Deb said, other than the name being different, I don't think I know you're not going to hear anything different from us. We haven't changed our perspective. We haven't changed our work. If anything, we find it more motivating to have a name that we embrace, and a mission that we embrace, which I'm going to talk about a little bit today, because it's obviously the concept here is that it's aligned with your mission and with the foundation's work and with all of your work as in philanthropy in Vermont and the larger world as well. So let's go jump right into it. Whoops, let me see here. My thing is not letting me. There we go. So let's jump right into the results, which remain both good and bad, I suppose. I'd say mostly good, but not exclusively. So let's talk a little bit about what's happening. And I'm going to spend some time today, if you don't mind, on how we think about objectives versus the horse race. So there is a horse race that goes on. Obviously, every quarter we sit down together and we look at returns. And a lot of you, I'm sure, are like me, which is you look at the short-term returns just to see whether the trends are good or not, and you look at the long-term returns to see whether or not you believe that this is a good strategy or not. And frankly, we all weight them differently depending on what we're looking at and what we're thinking about at the time. And earlier this year, of course, the short-term results, in part because of the markets and in part because of the way we invest, which I'll talk about later, were just horrifying. We had gigantic double-digit losses. They were worse than the markets. I've had the honor of working for the foundation for over 18 years now, and we have never had a year like this, ever. Nothing even in the ballpark of it. So it really was quite disturbing, I have to say, for lack of a better word. And I've talked on prior calls about the fact that we didn't think we had done dumb things. We were, of course, vigilant about whether we had or hadn't, and that time would almost certainly heal a lot of what we have been doing, because they were things that were ultimately quite wise, we think, but we need to, of course, to eventually show you those in the numbers. So let's just start right on the column that I like the least here. So these returns you're looking at here, so these are net of investment management fees. These are the returns of the three major pools: the long-term pool, the socially responsible pool, and the midterm pool. And just look at the column I like least, which is the calendar year-to-date column. I actually don't dislike it for the socially responsible, the midterm pool, but the long-term pool remains about 4.4% behind its benchmark. With that said, given that the pool started the year down about 20%, the idea that we could be up 4.6 and actually, as of today, up 6.3% year to date is just stunning beyond belief. Now, we'd rather have 9, so we'll come back to that in a minute. The socially responsible pool, you can see up 9 and outperforming its benchmark. And then the midterm pool, which is largely an index funds, is tracking its benchmark. And one of the interesting things about 2020 is how well the midterm pool is done. And that's not because there's been any brilliance there. It's because the bond market is doing one of the great levitating acts of all time, which we will talk about a little bit later, because it's got significant implications for investors on a long-term basis. So the SR pool numbers look great across the board. I'm going to come back to that a little bit in a moment, actually, because one of the messages I want to leave you with today is that a lot of things are cyclical in this world, and something that looks good is sometimes good. Sometimes it's better than you think. Sometimes it's not quite as good as you think. The SR pool is great, by the way. Our goal here is to deliver 2 very competitive pools for all of you to choose from. In the case of the long-term pools, I mean. Now let's go back to the long-term pool itself, though, and the struggle it's had this year. And let's also look at the fact that you might say, wow, it's not just this year you've struggled for 3 years, you struggled for 5 years. And actually the answer is that's not exactly what's happened. When you underperform by as much as we have this year, and I'll talk about that in a moment again, as I said, it actually kind of bleeds its way across. It's what we call endpoint sensitivity. So a year ago, our 3-year numbers did not look bad, and our 5-year numbers certainly didn't look bad on a relative basis. So that's really important to consider. This has been very much a COVID-related issue. And just to get to the punchlines, we'll talk about this later, it's very much around the fact that we think price always matters in investing, and we are not going to buy into popular stories that just happen to be working at this moment in time, because you do that with great peril for the thing we actually do care about most, which is the very long term. So go to the 10-year column, the 15-year column, and the since we started column. And those premiums, we must have those premiums. And I will show you later why they're so important, because when you get to the ultimate goal of what these assets are here for and why you've chosen to partner with the Community Foundation, it's not really about the short-term horse race. It's very much around, protecting philanthropy, protecting the value of your capital on a very long-term basis. And these numbers on the right are really, really important from that perspective. Now, I did, of course, want to offer some sense of good news. We also included a since March 31st, 2020 column. We don't usually include 8-month performance on these reports, but I only did it not to say, oh, we're not as dumb as we look, but more to say things have already started to turn and change in our direction. So a lot of the recovery that has already occurred, we think will occur, and the 18-year and the 15-year record and the 10-year record, their relevance will become increasingly clear as we move through time. So I will continue on. Oops, I keep doing this. I don't know why it does this. There we go. So this is a little complicated, but I wanted to show you 2 things. One is how unusual this period has been. So the way you look at this graph is what we've done is on the prior slide, you see we compare everything to a custom benchmark. So here what we do is we compare on a rolling 3-year basis how the main pool, the long-term pool, not the main pool, the long-term pool is done compared to its benchmark. So when you look up here, it's the long-term pool custom benchmark. That's what we're using just through time. But instead of showing you just things that end today, we're instead saying, let's look at every single 3-year period that has existed since 2002. And the blue line reflects the long-term pool. So whenever it's above the black line, that means the long-term pool is outperforming its benchmark, the one I showed you earlier, on a 3-year basis. So every 3-year column I would have drawn for you over the last 18 years up until recently would have shown the pool outperforming. So that plunge you see on the right side of the graph, that's what I was referring to earlier, which is this extremely unusual climate we're obviously all living in. We're talking about bingo Zoom today. So, I mean, stuff we wouldn't have talked about a year ago, I don't think. And you can see what's happened. So it's kind of plunged. Now you can see it's starting to come back a little, but we're still the shock of what happened in March is still having significant implications. But here you also get to see what I referred to earlier, which is that the portfolio actually doesn't usually underperform on a 3-year basis. This almost never happens. And in fact, the last time it happened was briefly in 2006, as you can see. And then that was quickly followed by one of the great performance periods of the pool in its history, which is where that blue line starts to soar on the left-hand side of the page. So keep that thought in mind for a minute. That is extremely important. And actually, we are, I think, beyond excited about the relative return prospects for this portfolio and the absolute ones. I'll talk about that a little later. Now, the gold line, though, is the socially responsible pool. And it's very interesting. So you look at it back here and you say, well, the SR pool, look at it. It's always a better investment than a long-term pool. I mean, 10 years, 8.1%, better than 7.7, better than its benchmark, simple, right? But now you look at this, you're like, not quite the same story. The SR pool, by the way, is a great pool. You can see it outperforms the long-term pool's benchmark most of the time as well. But you can also see that it actually has its periods where it's above the blue line and those where it's below the blue line. That's the cyclicality. And our goal in life isn't to actually have 2 different pools per se. We do have 2 different pools. We do that because the SR pool has a very strong values alignment with the Vermont Community Foundation's goals, objectives, and values. However, so it gives it a different flavor as a portfolio. It makes the opportunity set different and the portfolio different. But my point being that you have two strong pools, each gets its good days and its bad days. And when you put them together, they both have very good long-term records. And that's what this shows you. So the SR pool for 10 years, 8% per year, 20 basis points above its benchmark. You look at the long-term pool, actually above its benchmark for 10 years, 15 years, and 18 years. So that's the ultimate goal. But along the way, the roller coaster goes in different directions, so to speak. And so that's what we're always focused on. So I would love for you not to walk away thinking, wow, the SR pool is just a much better investment strategy. I would more say two really good strategies, and this one is doing better right now because of the way it's invested. So let's talk
Right.
about, yes, please.
We have a question from someone from the group, and they're asking a little bit about the benchmark that we're using. Like, how is the benchmark crafted, and what is it comprised of? Can you just take a moment just to kind of jump into that for a second? Because I know we're talking a lot about our returns as compared to benchmark. We talk about the customized benchmark a lot internally with our investment committee, but will you share with the group what that's about?
Yeah, absolutely. In fact, I'm going to jump ahead to this slide I put up on the
Great.
screen now, Deb, because that's a great question. And I should have probably mentioned that before. So thank you for the question, whoever asked it.
Oh.
I can't see that part. So thanks for interjecting there, Deb. So what you're looking at here, and this is going to tie into the question, I promise, you're looking at the strategic asset allocation strategy of each pool. So you can see that the long-term pool has 52.5% of its assets. This is by policy in equities. The SR pool has 60% in equities, and you can see the differences in bond exposures and then alternative exposures at the bottom, plus the Vermont investments, of course. So what we do to calculate that benchmark that we talked about earlier is we apply a standard market index to each piece of this pie. So for example, the long-term pool has 11% of its benchmark in the S&P 500. It has 5.5% of its benchmark in the Russell 2000. That's a proxy for small cap stocks. The SR pool, by contrast, has 19% of its weight in the benchmark in the S&P 500 and 5% in the Russell 2000. And so that's how we get the benchmark. So what the benchmark reflects is it neutralizes the foundation's investment decisions, the strategic policy mix I'm referring to. And then what it does is it just says, let's apply index funds to our strategy, and we will get a benchmark that answers a simple question, which is, going back for a second, would it have been better, let's say we had the same asset allocation strategy, would it have been better to just have put the money all in index funds? And the answer is, for the long-term pool this year, absolutely yes. But over the longer periods of time, absolutely no. And the SR pool, same story, absolutely no. These are net of those fees. So there's been a benefit to having a portfolio, which, by the way, consists of both index funds and consists of active managers. Hopefully that answered the question. So we have a thing we've been doing at our firm, which is a daily call that started back in March. We didn't used to have daily calls in our firm, but March, again, shook up the world in so many different ways. And we were obviously very wary of this, economic market cataclysm occurring. Our clients, who need to have these funds available, particularly in a crisis like this. And let's make sure we always thought we were very much on top of things, but let's get even more on top of things. And so these daily calls inside of Colonial/Crucial have had, there's been hundreds of hours of calls now, but the point being that there've been certain themes that have come out, and one of them has been what we call ice in their veins investors, because the view was that you had to have ice in your veins to not kind of lose it a little bit back in March and April, because it just, the story was going to be bad. It is bad, by the way. And, how do you not react to that? And even as a long-term investor, think, oh, this is not going to be good. I need to maybe protect this portfolio. I mean, that's a natural, normal way to think about things. It's also wrong in most cases, and this year's proven to be no exception. So the foundation strategy, so I'm also going to say that Dan and Debbie and the investment committee also will get the Ice in Their Veins award. That's an award, by the way. It's not a bad thing, just to be clear, for the year, because these recoveries you've seen in the portfolios this year could not have occurred if we had kind of, taken our foot off the gas a little bit in terms of looking at the long term. So the philosophy is very simple. 3 points. Point 1, think long term. That's what a strategic asset allocation process is about. 2, do not make decisions based on short-term events. COVID doesn't feel like a short-term event to any of us, but in the history of of humankind, it is a short-term event. And so therefore we can't be too focused on it, even though it was hard back in March and April not to want to do something about it. But we did something about it, which by the way is we rebalanced, we stuck to our strategy, and there been handsome dividends have been paid so far, and we think a lot more to come. And then the last point is, though, if you're not going to make short-term forecasts, you need to be diversified. So when you go back to the next slide for a second, I talked about this mix a minute ago. One very legitimate comment you can make, and we're going to come back to this a little bit later, is why wouldn't you just put, I mentioned 11% in the S&P 500, 19% for the SR pool. If the whole thing in the S&P 500, this portfolio would have done better. However, that's not diversification. And we're going to talk about that a little bit later. It's not enough diversification. It's certainly not as much as we can have. And we actually think being diversified actually doesn't just make us feel better and protected. It actually delivers better outcomes. And we will talk about that a little bit later. The last thing I want to point out on this page is, again, back to the SR pool versus the long-term pool. The SR pool's had a big advantage in two senses, one of which shocks me, but it's interesting, actually three. The first is it's got more in stocks. And actually in 2020, it's hard to believe this right now, having more in stocks has been good. So that's just a stunner for us. The second thing it has is because of the way it's invested, it has more exposure to what we consider to be growthier areas of the economy. So tech and healthcare are commonly bigger weightings in socially responsible portfolios. And that's been a wonderful tailwind this year. We'll talk a little bit later about growth versus value, but growth stocks have crushed value stocks this year. The long-term pool is a more balanced approach, even a more tilted to value approach. So that's the other factor that's really helped the SR pool this year a lot. And the third, and this is the one that just stuns me, is the bond exposure. In theory, who would have thought that if you start the year at, I don't know, 1 point whatever percent on the 10-year treasury, that having more in bonds would be a good thing? It's been a fantastic thing. 10-year treasuries are up 12, 13% year to date. If you went to even longer term treasuries, they're up 20, 25% year to date. I mean, it's a massive level of interest rate decline this year, which has really generated a lot of juice, forgive the expression, from the SR pool's bond exposure. So the SR pool's had a lot of things going for it, and the long-term pool has had fewer. Last but not least, you can see the midterm pool has a much more balanced approach, basically 47.5% in stocks, 47.5% in bonds, and then of course the Vermont investments make up the difference. So I'm going to go through this quickly because I do want to get to, there's a really big picture point I want to spend time on, but I wanted to point out one thing, which is that the foundation has had a very long record of outperformance, which we'll talk about a little bit later. And that's come from this blend of active and passive management. So active management is well regarded and properly regarded as a very difficult thing to do well. And it is. And so we wake up every day trying to do it well. And we've had a lot of success. As you know, the committee and the foundation overall has had a lot of success. And there have been four basic principles that have governed this. One is that returns are always accompanied by risk. So we're not trying to get rid of risk. We're trying to understand the risks we're taking and balance them. The second point is we spend a lot of time getting to know the people who manage money for the foundation. We're constantly talking with them, constantly reading what they have to say. And this is not about the numbers with them. This is about the people. Do we have the right people with the right frame of mind, with the right level of intelligence, with the right work ethic to really deliver for us as long-term investors? Third, where we don't take risk is an operational side. There's a big giant process around operational due diligence and making sure that we don't have any Bernie Madoff type situations ever in this portfolio. So there's a tremendous amount of protection there. And this is the big one. It's always a forward-looking process. The reason that managers don't work for most people is they make a very critical mistake. They hire on track record, they fire on track record. So when you hire someone with a great track record, it's very hard to know whether or not you are buying a talented person or somebody who's cyclically doing well. So I will tell you this, if you're looking at people right now in your portfolios that you've used actively managed portfolios of it all, anyone who has tech and healthcare in their portfolios looks like a genius today, even if they're not. And people who like to own cyclical business all look like fools, even if they're not. And so the job is to figure out who are the real geniuses and who are the real fools, and try to, of course, emphasize the former and not the latter as much as we can. So it has to be forward-looking, and don't forget, everything is cyclical. I'm going to jump here ahead, if you don't mind. I see that another question came up, Dale. I don't know if you want me to address that now or not. I just can see the thing on my screen, but I can't see what the question is.
Okay.
Yeah,
thank you so much. Dan, did you want to jump in?
sure. Kel's question is that we, noting the 5% allocation to investments in Vermont, that given the the size of the pools has grown to, Deb, roughly a $13 million asset allocation. That 5% allocation stems from a board direction to the investment committee, a board policy that is predicated on the idea that we could be investing our assets to advance our mission in Vermont communities. So we've put a stronger degree of strategy that balances both the mission-related benefit of those investments alongside the financial return on those investments. And so related to the overall performance of the pool, we benchmark those to something more modest. I think we benchmarked them to short-term bonds, and we're actually meeting today to discuss whether we should adjust that benchmark even further to reflect the mission-related impacts that allocation pursues. The interesting thing is that these mission-related investments are sort of a subset of the SR values-oriented investing, which is a really substantial piece of growth for us as an organization in terms of new funds. Deb was showing me some data related to funds being opened at the foundation in the last 3 to 4 years. And it's something like there are only probably a half dozen funds that are selecting into the long-term, that have selected into the long-term pool. And the reality is probably 45 or 50 funds have selected into the SR pool. So more and more investors, particularly philanthropic investors, are looking for a value screen. And since we're a place-based philanthropy, this 5% is a pretty key piece of strategy for us related to the impact we have in the places for which we seek our objectives. I think we're still making responsible, good financial investments, but we also put a strong mission premium on those. So.
Thank you, Dan.
Hope that answered your question, Kel.
Question.
Excellent question. And so the other part of what Dan was just referring to, so there's so many ways to peel back the layers of how the Vermont Community Foundation and all of you have impact in Vermont. And one I've been referring to a few times is what's on is on this page, which is to preserve purchasing power. So both the SR pool and a long-term pool, that is the reason to be, the why of those pools is to preserve purchasing power. So we need to think about how do you do that, which is a long-term outcome issue, of course, but also at the same time, we do own things like bonds and other strategies because 2020s happen and there's more need and we have to be able to obviously fund the important work that the foundation, all of you are doing. And, when you own just, for example, all stocks, which we'll talk about a little later in a minute, you end up having to sell at the worst possible times because unfortunately, as we saw this year, the greatest need can emerge when the worst market conditions are also occurring. Now, it's kind of gotten weird at the end of this year where the markets are great and the need is still growing, as we all know. But that doesn't, both can happen is our point. So we're trying to always strike a balance between the fact is that there are and always will be issues that need to be addressed right here, right now in the state. At the same time, we need to preserve purchasing power. So how do we balance those? And so that's all about the diversification and the other issues I referred to earlier. So we've got a way that we measure this and think about dollars. So I mentioned earlier that diversification, balance, value-oriented investing to some degree are not just about sleeping at night. They're about generating better outcomes. So what we did to kind of prove this point here is we looked at what would happen if a fund had shown up basically the end of March of 2002. We use that date because that's when then we started working for the foundation. So that's the track record that we feel we're accountable for. And what happened if we took that $1 million fund and we invested it in one of 3 portfolios? The pool, the long-term pool, the second one being a 60% blend of global stocks and 40% US bonds, and then just all global stocks. And then all we did is we took out 5% of a 36-month rolling average along the way, never added any money to the fund, and said, okay, what did we end up with at the end of November? So the first set of columns shows you that the money, the quote unquote, the ending fund balance in the pool was about $500,000 more than what it started at. So that it started with $1 million. We're showing you just the growth, not the actual value here. So it started with $1 million, it ended up with about $1.5 million, give or take. And that's again, after distributions, which are the second column. So over $1 million was distributed over this 18-year period, give or take, to the community, and that's the blue bars again. And then we total charitable impact, and I'll get back to the comparison in a minute, just adds the first two bars together to say, okay, well, if you had a higher ending fund balance, which you can see, it's not a big difference, but it's bigger, and you had higher spending, you had higher impact. So that's impact may or may not be the word you guys would choose, but it's the word we used on the graph. But it does add up two very important things that are not about risk or anything about, but mostly about all about dollars, in fact. So the orange bars, again, are the 60-40. And you can see the impact has been far lower. So the growth was lower, the spending was lower, end of story, not so good. The gray bar is 100% global stocks. And you can see the first part, not bad. It's almost as good in terms of ending fund balance as the pool. However, in the middle bars, you can see, well, that came at a price, which is less money was distributed. And the reason less money was distributed was the 36-month average, and a lot of volatility are a really, really bad equation. They end up, by the way, kind of robbing philanthropy in the state at the worst possible times and create long periods of droughts. And we'll talk about that in a minute. So that's why the pool's been really successful on, this really critical element. I mean, this is, at the end of the day, this is about dollars and putting dollars out into the community and then having dollars for the future. And that's what this suggests that has happened at the long-term pool compared to these two measures. But then let's go right for the problem, which is, I mentioned this before, but the S&P would have been better. And it absolutely would have been better. And this is what this graph shows you here. Well, it's not a graph, it's a table, sorry, which is the cumulative returns from that same period of time I showed you earlier for the S&P 500 compared to the pool. The pool has underperformed the S&P by almost 32 percentage points. That's cumulative, but nevertheless, huge, huge level of underperformance. Would we not have been better to put all the money in the S&P 500? And the answer is, from a purely numbers perspective, we would have been better off to be in the S&P, with a very big but coming in a minute. But the key point is philanthropic impact at the bottom. So 32% less return, but only 12% less philanthropic impact. So again, remember, philanthropic impact isn't just the return, it's also what went out in a spending sense. So the S&P, because of its volatility, has forfeited a lot of philanthropy over the years in order to get to, admittedly, still a better outcome, because the return difference was so big that it wasn't just going to be purely made up by having less volatility in your portfolio. But the fact is that the S&P still was more successful than the pool until you look at this. So this graph takes those middle bars from the first graph I showed you earlier, the spending, and looks at them year to year. So the blue line is the pool again, the long-term pool. We left the 60-40, which is the orange line from the first graph on, and then we got rid of the all global stock index, which was the last bar, if you recall. Instead, we just used the S&P this time because that was the winner. And take a look at the graph. This is a philanthropic nightmare, which is the S&P, first of all, just recently got above the annual spending of the pool. So again, it took the S&P basically 17 years to catch up. That's a huge problem. More importantly, if you look out from the beginning, so we started in 2002, get to the trough in around 2011, 2012, the S&P had actually delivered 17, 18, 20% less philanthropy, or actually more than 20% less philanthropy over the course of a decade. And so it's a disaster. And look at those giant slopes downward. Now, this great recovery at the end is wonderful, but if anyone who's run a nonprofit, you wouldn't want that as your funding source. Obviously, over time, you might not make it. And so the key is, while the blue line's not perfect, it's generally stable. It does have its weak periods. The middle part in the graph where you can see it dropping a little bit, that's the 2008 period, but still not too terrible. But the growth trajectory is generally higher. It's more stable. And when you combine this, which is a better outcome compared to responsible portfolios, to this, which says, not as happy with that, but then you throw this into the equation and you say, okay, maybe this is a better deal in the S&P, a much better deal. And then it gets a little worse for the S&P as we move on. So let's talk about the markets today. So I mentioned earlier that all assessment is forward-looking. So for example, if you said to me, well, the S&P's outperformed for 10 years, what does that tell us about the future? And my answer is, well, it doesn't guarantee anything. And in fact, you could argue it tells you the opposite will happen for the next 10 years. And I'll talk about that in a minute. So the key points today is this. There is a massive trap being set to the third place for people who don't understand that investing is about what you own and what you pay for what you own. Just like everything else we do in our lives, what we pay for something really does matter. It's no different in investing. The problem is investing and markets can defy gravity for a period of time and then they stop. And when that stop occurs, that's when you can get in big trouble. So today, there's this dichotomy between the big winners, the S&P's largest companies, which we'll talk about in a minute, and everything else, which looks like a disaster. And the future returns are going to be very different. History is very clear on this point. I'm going to show you that in a minute. So here is the first problem if you own the S&P 500, which in history starting in 1990, in this case, we have never seen more of the index in just 5 stocks. And so these 5 stocks have become 22% of the index. It's actually a little bit, I think it might be a little larger today because this was September 30th. But the point is that those 5 stocks, which will surprise no one to hear what they are, Apple, Amazon, Alphabet, Facebook, and Microsoft, all tech / large consumer companies, all incredibly large investments in the index. So this is a record level of concentration in the index, which is important when we talk about risk, particularly when you switch to the next slide, which is, let's go back and look at the same story, but back here where the 18.2 is. So last time the index was this concentrated was in 2000. And here were the 5 darlings at the time. By the way, all companies that are still in business. And I went over this in the October call, so I'm going to be really quick here. For those of you who don't recall it, I'm sorry for rushing through it, but I want to make the point again. So the 5 stocks today these 5 stocks have very high valuations, which is very similar to what Amazon and Apple and those look like today, by the way. If you look at the right-hand column, let's you look at Cisco for a minute. It's been an extremely successful company. 10% earnings growth over a decade. That's basically double to triple the rate of the economy's growth. And when a large company does that, that's a miracle, basically, to see that happen over such a long period of time. If you went back to 2000, you might remember there was a very, very good story, which is that Cisco was going to dominate a world which would be dominated by this thing called the internet. And you know what? Both were right. It's exactly right, the story. So you can get the story right. That's not necessarily enough, though. And then look at the middle column. The stock's down 50% over the last 20 years, despite the fact that it grew like crazy. But the problem is it was at 200 times earnings. And that's, again, price always comes into play at some point in time. So it's not an accident that 4 of these 5 stocks, they're not just bad investments. So they didn't just underperform. They're awful investments. And again, I hope I can sit down 10 years from now with all of you and show you what happened to the darlings today. It may not be these exact losses, but it will not be pretty. And it will not be nearly as good as the VCF's portfolio. So that comes into, I'm going to jump ahead to another thing I wanted to get to, if you mind, because I want to leave time for your questions. Let's get to what we're trying to accomplish again. So I put this graph back up at the top, which shows you the spending. So we want to preserve purchasing power, and we want to create a spending pattern that supports philanthropy in the state. So the top graph shows you that that blue line, as I mentioned earlier, has been quite successful in terms of stability. And then I want to show you the bottom. So before I talked about the horse race, so long-term pool, custom benchmark, how are we doing? Year to date, not so well, as we talked about earlier, but longer term, quite well. But I think what I really want you to focus on now is the last line, which is preserving purchasing power. So you want your stability and you want to preserve purchasing power. Well, look at the graph, look at the chart across the page. So you have to go out to 5 years admittedly, but at 5 years, you start to see something really important, which is that basically the pool is outperforming CPI plus 5. And we're particularly proud of 15 years and 18 years, because in that case, the outperformance compared to the custom benchmark was the difference between success and failure compared to the CPI plus 5. And my point being this, yes, Amazon and Apple can double in valuation from here, and Apple can trade at 100 times earnings, and Amazon can trade at 250 times earnings. However, no one's to stop that from happening. There's a lot of people who would love to see that happen, and maybe it will. But the reality is it's not very likely to happen. And so what we want to do is we want to be diversified away from those kinds of stocks. We do own some, just to be clear, because we want to own the things that are trading below book value today with 8%, with 5%, dividend yields, and trading at 8 times earnings, because that stuff gives us a much greater chance of earning our 7 to 7.5% return, which we must have. So we cannot afford to have a lot of our money in those 4 of those 5 stocks, because that will not allow us, to generate this. So we tolerate the calendar year to date, and I hope you can too, especially now that it's at least a positive number. But we tolerate it in pursuit of a much better long-term outcome, which does both the stability, provides the stability at the top, and also provides the return that we must have at the bottom. So with that said, let me see if there are questions, and I have a couple wrap-up comments, if that's okay.
There's no questions in the chat, but does anyone want to unmute and ask a question to Mike directly? Give everyone a moment because I know finding the unmute button sometimes. All right, Mike, so far so good on the question. So if you want to jump in, if you had a few things you wanted to share, feel free. And people, if you do want to jump in, you can, oh, we got one. Aaron asked about, can you comment about the seeming disconnect between the stock market and the larger economy?
Yeah, it's a great question.
Yeah.
So in theory, the stock market is a forward-looking discounting mechanism. So in theory, you would expect the stock market to get ahead of the economy. So that part sort of makes sense. In fact, I think since the vaccine announcement started coming out, and I think we can put the vaccine if you like, and actually the foundation, believe it or not, has not a large, but a large enough investment in Moderna that it's actually part of the recovery that you've seen in the portfolio. One of our managers had a pretty large position, but it wasn't that large a percentage of the portfolio. But the vaccines have the part of the market, what the market's done since November 6th or 7th, whatever date the vaccines were publicly announced, makes some more sense, because now what the market's doing is saying, you know what, at some point in 2021, we'll probably be on the road to a normal life. I want to be clear, not in a normal life. Vaccines are not that great an answer. They're good, very good actually, but they don't just magically make the problem go away. The interesting thing, the prior to November part of the market, I'd say the April to August part, where people were mystified by what was happening, that made sense. And we actually wrote a piece. I don't know if we distribute these, but to the broader world, but we wrote a piece about Robinhood, the trading platform, in our last quarterly commentary to the committee. We think the market just turned into a stay-at-home casino. And so what happens is and I'll go back, and this is going to give me a chance to go back to one of my other slides I wasn't going to talk about. Oops, sorry. So if you take a look at this, we do live in a different kind of world. The markets are not controlled by people anymore as much as they used to be. The computers are really, really important right now. We live in a world of computers. It's not just our Zoom calls and our phones and everything else. The markets have a gigantic percentage of what's going on is driven by computers. We use things called high frequency trading to describe this, or quantitative investment strategies. And they are a major market force. One, because they have a lot of money, and two, because they trade like crazy. And so, keep in mind, market prices are just the supply and demand for securities at any moment in time. So those who trade the most have the most impact in some ways. So the funny thing, or not funny, but the interesting thing about what happened is when the spring occurred, and if you read our piece, which I hope we can go to our website and see it too if you want, but we talk about the fact that, you get the Dave Portnoys of the world who basically get out there and start, since you can't bet on sports anymore, let's just bet on the markets instead. And you create this whole kind of wave of people who are starting to become day traders again. And you might say, well, do they really have enough money to move the markets? The answer is, of course they don't. However, the quants were paying very close attention to them and basically chasing them around. And so that led to these gigantic swings. And so when you were looking at the market and saying, God, this makes no sense, what is going on? The answer is it just turned into a big casino from March until basically September of this year. It might still be a casino, by the way, depending on your point of view. But at least now it's actually operating in a way that makes more sense if you agree that the world's going to normalize next year. I think that's a really important part of the answer to the question.
Any other questions? Feel free to either unmute or put it into the chat box. All right, we have another question. Let me just read it a little bit. Guess everyone can see it. Some commentators and pundits are suggesting a shift to international and to value in 2021 and beyond. Do you contemplate any adjustment and allocation weighting in the year ahead?
Yeah, great question. So that makes me nervous, by the way. We like being kind of off at our own little place that no one agrees with us. So that you're right. People are starting to think that international makes sense and that value makes sense. And by the way, we're happy to have it because we do want to see the performance get better. And that's part of what's contributing to that 29.6% gain you see here for the last 8 months. But the answer to the question is that we don't expect a lot of change because we're already there. And that's why the 4.6 is a 4.6 and not a bigger number. If we'd been just sitting on Amazon earlier or more of the year, we'd be doing better this year. So we don't expect a big change, but I do think that the change makes sense. And again, because the disparity in price is just, Amazon can't possibly do well enough to justify the difference. Let's put it that way. But I would say this, where you will see some change on the margin is to continue to press our advantages, which is here, which is we are very consistent. We are very slow moving, by the way. So there's not a lot of short-term change that occurs in the portfolio. We usually say this with a more joy, but we usually like volatility. I will tell you, obviously, no one enjoyed, and this includes us this year, the volatility in the markets. It was way more than we ever bargained for. But my point would be back to changes in the portfolio. As long as we can buy value stocks and especially non-US value stocks at, as I said, single-digit price earnings ratios with 5% dividend yields and great balance sheets, we think we can get paid 15 to 20% per year to own those over the next 5 years. By the way, to put that in contrast, we think the S&P 500, if you're lucky, will get you 3 to 5% per year. That's the difference in returns we're looking at from this point forward. And that's just simple math around valuation. And so my point being this, if the non-US stocks just meander higher and do better for next year, 15, 20% versus the S&P up 5, we probably won't change a thing. What could happen though, in a quantitative world, is the non-US stocks could be up 50 and the S&P could be up 10. And then we'll start to slowly rotate back towards the US, because we do like to own US stocks, by the way. We love to own growing businesses. Who doesn't? But we don't want to pay too much for it because back to this page, we cannot make sacrifices on those 15-year and 18-year columns. And when you put too much money in an overvalued index, you're almost guaranteeing yourself that you're not going to achieve those goals.
All right, just checking the time. We still have a few more minutes. Are there any other questions, or Mike, is there anything else you wanted to say in wrapping up? I know you said you had a few questions.
Yeah, just one quick one, if you don't mind, which is this point I made earlier, which is that when you do a simple kind of forecasting based on valuation, again, I'm sorry to keep pounding on this point, but you really do get to the place where you say, how do you achieve 7 to 8% returns in a portfolio? Again, the S&P 500, again, we think we're being generous at 3 to 4% returns for the next, now let's use the next decade. That's our actual measurement period. So if you can only get 4%, let's be even more generous. Let's say you can get 5 from the S&P, which would be, by the way, historically out of the norm because of the current prices. 60% of your money is there. You got a 3% return. What are you going to earn on the other 40, which is your bond portfolio? Let's be really generous there too and say you're going to get 2, which seems ridiculous because the 10-year treasury is 0.9 today. So I'm not sure how you're going to get 2, but let's say you do get 2. So you've got 3%, plus you get another 0.8% from your bonds. You just made 3.8% per year. So if you go back here, if you needed 7 and you got 3.8 over a decade, you are basically going to be 30 to 40% in the hole from a philanthropy standpoint. So when you look at all these graphs and all these returns, we're showing you everything in nominal dollars, not in real dollars. But if you actually lose 30 to 40% of your purchasing power over the next decade, you have a huge problem. And that's a problem that's very hard to recover from. So when we look at, extremely cheap cyclical sectors, like I mentioned earlier, and non-US stocks in particular, almost anywhere you want to go in the world, it's easier to get to the 7, 8. You can do it. It's not that hard. And so the fact is that the choice we all face is a simple one. Do what's popular today and maybe lose 30 or 40% of your purchasing power over the next decade, or do what's not popular today, feel bad about the short-term returns like we do, calendar year to date, but then wake up and say, you know what, I know 10 years from now, because we'll stick to this strategy, we will not give up at the wrong time. We will not do foolish short-term things. We'll be able to show you a graph like this. And I hope everyone else does well too, by the way. We're not rooting for anyone to fail, but we actually don't like the chances of people who are investing conventionally today. I think it's a huge, huge risk for them.
I guess the last question, and then I think we'll be wrapping up, is that someone, David mentioned the last time we presented returns by asset class. Do we have those numbers again? I believe that information is actually on our donor information. Let me know. I believe that's what we do in our monthly summaries, and we show the returns by asset class. But Mike, correct me if I'm wrong, and if not, we can definitely get that information. And Mike, I don't think you have it in your fingertips in this slide deck, but just feel free to comment.
Yeah, no, and I think that's actually a great point. So we will add that. And I think I probably said this last quarter, so I apologize for not following through. But if you go to the quarterly, we write a quarterly report that is posted. I don't know, Deb, where you guys posted exactly, but it does show year-to-date asset class returns for all in detail for each of the pools. So you can see that data if you need to see it right away. But I also agree that I believe that was a request from last time, which will be fulfilled next time, I promise.
And thank you, Stacy, thank you for letting me know that my high costing wireless internet here is not coming through. I will make sure that we have it. I believe it's either on our Donor Central portal for fund holders or on our website, but I'll get that information and make sure it's available to people who are interested. Are there any other questions? Oh, okay. There's one last question, and then I think we'll wrap up, but some good questions. Someone was talking more about, and everyone can see this, that there's a article that Mike discussed on gambling investments. Is that available? I believe that it's also was on, I want to say it was on VPR or NPR the other day too, about people going and doing day trading. So I think it's definitely a topic out there. So Mike, if there's any interesting articles, maybe you can let me know about it, or we'll look into it and we can post that as well. But if you have anything off the top of your head, if not, we can start to, kind of see if there's anything out there to share.
Yeah, I think the question might be a reference, Deb, to the piece we wrote about Robinhood, which is entitled "Stealing from the Rich and Stealing from the Poor and Giving to the Rich." And it's, I'll make sure we get that. Deb, I think you might have it already.
Yep, I have it noted that I would be sending that out, so we have that article queued up, ready to go. Thanks for the clarification. I misread that question, so thank you.
And then there was one more question. I don't know if you can answer it off the top. It's related to David Wilkins' question, referencing hedge funds as an asset class from Michael Metz. We'll obviously get into a little more detail on the committee in the committee discussion that starts in a little bit. But do you want to characterize the hedge fund performance?
Yes, the hedge funds have been a significant contributor to our misery this year until about 3 weeks ago or 4 weeks ago. So the hedge fund portfolio was really struggling this year. It was struggling because it was very value oriented. It was struggling because it had kind of more below investment grade credit in it. And then boom, the vaccine hits and everything changes because the two biggest exposures I mentioned, value oriented, but to be a little more specific, cyclical companies and travel related businesses were pretty significantly included in the hedge fund portfolio. The managers, to their credit, and I see David's other comment here, which I do want to add to if I might, the managers, to their credit, did not panic. They had ice in their veins. And so the hedge fund portfolio is now actually up about 3 or 4% year to date, which is still nothing to write home about, but it was down like double digits as recently as 2 months ago. So it's having a remarkable recovery as we speak. And we actually think it's been a long-term contributor to returns in our view, but 2020 was just horrifyingly bad until about a month ago. By the way, just so you know, the Moderna position I referred to earlier is inside the hedge fund portfolio. So that's part of the argument for holding hedge funds is that you have people doing things that are different than other parts of the portfolio, and that proved to be true. But you had to wait until the vaccine was announced to see that as a benefit, not a cost. And then David, can I go into David's ultimate? There was an article by Jason Zweig in the Journal about Robinhood. He talks about his experience trading on Robinhood. So I read that last night myself. I hadn't seen it until last night. It actually is fantastic. He's always a fantastic writer and investor in our opinion. And then our article, you'll see, is not about, we didn't open up any, he opened up a Robinhood account to see what it's like. We talked about the experience of doing it, but we're more focused on how Robinhood is basically, if you don't, it's not free is our point. You'll read about how they make their money, which is part of our argument, how it's not a very good idea, most of it. But with that said, and it encourages bad behavior.
Well, thank you, everybody. This was great. I really appreciate the questions. I apologize. They were starting to scroll beyond my screen. So thank you, Dan and Mike, for noticing a few of them that I had missed. So I really appreciate the interaction. I think that makes the call even more meaningful for people as we sit here and look at this unusual year of 2020 for many, many different reasons. Investments, obviously, for this committee and this group of people focused, but so much more. I think there's some more questions. What I might do is, I'm just looking at the time. I think we need to start to wrap up a little bit. So why don't I look at any other questions that have come up? And as we send out some information to this group, if there's other questions that are asking, we can actually address those either in this next kind of communication or in our next call, if that's okay with everybody, just to manage the time right now. So if anyone else has a final thank you or, question they wanted to say, thanks to Mike. Everyone can kind of thank that to Mike. Thanks, Mike, for keeping us focused and showing us the structure that we're using so that our fund holders can understand what we're doing and why. Like I said, it's a crazy year this year and we appreciate your guidance. This will be saved to our website for people to reference in the future along with the slide deck. If you don't know where that is, feel free to reach out to me or Kim and we can get you that information. And we look forward to talking to you in 2021. I hope you all have a happy and safe holiday season and always stay safe during this time. So thank you so much for joining us, everybody.